Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us as we wrap up the day and the week. Not a great way to finish. I'm sure you're aware, if you've been at least casting the odd eye on the market today, has been very negative indeed. In fact, tracking the biggest weekly fall in 3 months, as weak sentiment, particularly towards technology stocks, and also got that ongoing volatility, particularly in the commodities, have dragged the broader market lower, and very hard to find any stocks in the green at the moment. The S&P ASX 200, it's down around 2.2%, all 11 sectors in the red, and for the week we're off about 2%, and more broadly, we're back to where we were this time last year. So we've gone nowhere over those 12 months. Well, I'm kidding, of course. We've gone, it's all been marked by volatility, hasn't it? Let's get to the themes of the day. Red Sea. Yeah, not a place you want to go, is it really? The Red Sea? But that's what it is at the moment. It is a sea of red on the local bourse. Rio says no. So the on again, off again. Look, they've tried this a number of times. The merger with Glencore, both companies saying no, can't see the value for shareholders there. So that is off, perhaps for the relief of shareholders, certainly locally with Rio. The last time I looked was in the green, one of the few. Earnings outlook. Well, we're just slowly getting into earnings season. Only been a few this week. It's starting to ramp up certainly next week. And I talk about outlook. That's of course what it's all about. Not so much where they've been, but where they're going to. That's what investors are keen on hearing from these companies. Let's just get across some of the sectors that are moving. Well, plenty given. We're all in the red at the moment. Tech continuing to feel the heat. Look at those. Wisetech off another 4%. Tech One. These are companies that many are regarded as quality tech companies, but of course they're being slammed at the moment. That also applies to what we're seeing in energy. That has also come off significantly. Mind you, the oil price did fall, but in particular, take a look at those uranium miners. They were hit hard yesterday, and that has continued today. Deep yellow down more than 11%. And the goldies up one day, down the next. Certainly down again today. Newmont leading the losses there, more than 5% lower. And the REITs, look, of course, this ever since we had that rate hike on Tuesday, the REITs have been feeling the pressure given how sensitive those stocks are to interest rates, but in particular today with the broader market falling, so too have the REITs. Let's catch up with news then. Rio Tinto, as I mentioned there, walking away from talks to acquire Glencore. REA Group shares at a 2-year low after its half-year profit disappointed. News Corp, majority owner of REA, saying growth at Dow Jones and its digital real estate business offset weakening conditions in the Australian news business. Charter Hall Retail REIT saw after-tax profit more than double over the half. Web Travel, saying its Spanish subsidiary is being audited by Spain's tax authorities, so it has been slaughtered, down 30%. All right, well, let's unpack what we've seen this week then and check in with Shane Oliver from AMP. Shane, a very good Friday to you. Not a very good Friday on the share market, it would seem. What are your observations about what we're seeing on share markets globally at the moment? Of course, it's all about tech. There are a couple of stories playing out here. It's the threat AI is posing, particularly to those legacy software companies, but also investors very concerned about that massive spend we're seeing in capex.
That's right. It's a double-barreled issue at the moment. I guess to some degree, some of these concerns have been around for a while, but they seem to be coming to a head. I guess because we have seen those strong gains through last year, and valuations are such an issue. I mean, it could all blow over again. I mean, this time a year ago, we had concerns about DeepSeek and the question mark that posed for USAI. If DeepSeek could do things a lot more cheaply than others could, what does that mean for NVIDIA's chips? And of course, the market kept going on anyway and didn't worry about it too much after a brief little dip down. But by the same token, the higher the market gets, the more risky it gets, and that's an issue right now. We did see good earnings numbers over the last week. I think Microsoft, Amazon, and of course Alphabet all stood out on that front, great numbers beating and what have you, but the concern was about the capex, which is still winding up. And that, of course, is leading to those wobbles in the US share market, which incidentally, year to date is now in negative territory. And I think we've just, as of today, given up our gains for year to date as well. Europe and Japan are looking a little bit better on that front, partly as you can see from that chart. The other issue, of course, last night was we got some more soft jobs data. So all these things have come together. You get soft jobs data, job openings were down, concerns that maybe the Fed's not going to cut rates quickly enough and so on, combining with concerns about tech, and that saw the whole market come down. Whereas previously to that, we'd been seeing tech come down, but this rotation into other parts of the market. So whether that remains the case or not, whether the rotation trade comes back, remains to be seen, but I suspect that it probably will. That said, I have been thinking this will be a rough year. I remain of that view. I think we'll see another 15% correction. So far, somewhere along the way, so far it's only 2% or something. So that's still out there. Ultimately, I think that you are still going to see rate cuts in the US. Profits will continue to rise, and that'll provide reasonable returns for the year. But it's going to be a rough ride. And the history of midterm election years in the US and the flow onto our market is that they are often volatile years, and they see below average returns. If you just think about 2022, which of course was the inflation scare, or 2018, both turned out to be fairly rough years. Not always negative. I think we'll avoid a negative return this year, but I just think it will be a much rougher ride. And of course, you could argue at the back of all of this, you've got gyrations around Trump's policies, uncertainty on that front. Safe havens, they got a push up, and then they've corrected from excessively high levels, gold, silver on that front. Bitcoin, lots of issues around Bitcoin at present, 50% fall from its highs. So all these things are feeding into the mix and just resulting in a sort of a messy investment outlook, messy investment picture at present.
So, Shane, I mean, you mentioned a 15% correction on the cards there. What's that in the whole scheme of things? Take a look at what we're seeing with precious metals. Take a look at what we're seeing with Bitcoin at the moment. Just extreme volatility, as you said.
That's right. I mean, silver's a little bit different because it went almost exponential from over a short period of time, and so therefore it's seen this massive drawdown. Was it 20-odd, 30% last week, and another big chunk this week. Bitcoin's also a bit different. Bitcoin is correlated with the share market. You can't quite see Bitcoin in that chart. It looks kind of boring. Silver's the one that stands out, and then gold. But I think what you're seeing in gold is just a correction. The geopolitical risks are still out there. Not so sure about silver. You'd probably say, well, it's a bear market in terms of the size of the fall. But Bitcoin does have this habit every 4 years of going through a crypto winter, as some people call it. And if you look at them, the last one was back in 21, 22, and then I think 2018 going into 2020. On average, they're about 80%. So if you're an investor in Bitcoin and you look at the long-term charts, you'd say, well, that's been the history. Maybe we're due another one of them. And you could argue maybe that's what we're seeing right here, right now. I don't really know, but it does seem that way. And I guess, you've got to go in with your eyes open. I think Bitcoin is a potential store of value over the long term, but all of these things, Bitcoin, gold, they don't have an income flow to put valuations around them. So that makes it always difficult to sort of say, well, this is fair value and this is overvalued sort of thing. That makes it complicated. But I suspect the Bitcoin story hasn't gone away. It could well have more downside if it's only down 50%. And the normal crypto winter is 80%, then that suggests that there's more to go. So I don't have a strong view on that, but I suspect that at some point it just finds a bottom and then starts to creep up again, and then we'll all be talking about it once more on the positive side. But right here, right now, it does feel fairly negative for Bitcoin.
Well, and then of course there's the Donald Trump factor. He could start talking about it again, talking it up, and who knows where it goes from there, as we've seen in the past. Shane,
I don't think he's a credible person in that sense, and you can argue that that his talking about it last year might have been a negative for it.
Yeah, well, that's true.
That'd be my perspective on it.
So, Shane, you mentioned perhaps some concern in the states emerging, the weakness of jobs there, perhaps the Fed's not cutting fast enough. Of course, it's such a different story here we're seeing in Australia, given the RBA did hike this week. Now, you were of the view there at AMP that perhaps there wasn't a need to do so. You thought they might have remained on hold.
That's right.
Given what you heard from the statement, the press conference from Michelle Bullock, she appeared in Canberra today, justifying her decision. Do you think perhaps they're overly negative, more so than they need to be?
I think they are, but I can understand why they might be. They fear that if they don't sound tough, then they might lose credibility in terms of sticking to their inflation target. So I think that's part of it. They have revised up, as you can see from that chart, they have revised up their inflation forecast dramatically from where they were in November. Because don't forget, in November, the Aussie dollar was 4-5% lower, and the money market was assuming one more cut, and that's what fed into RBA forecasts. Now we've got the Aussie dollar 5% higher. That's a monetary tightening. We've got the money market assumptions almost 100 basis points higher than they were a year ago, or 3 months ago, and yet they see inflation staying higher for longer. That strikes me as a little bit too pessimistic, but by the same token, I could sort of see where they're coming from, and their concerns that demand in the economy has become excessive relative to supply does have some validity to it. Even if you agree inflation is going to come back down to the midpoint of the target, we're still talking about a much higher interest rate profile than we were, say, back in August. So it's still more negative than it was 6 months ago, and that possibly suggests that the environment has become more inflation prone, that there's less spare capacity and so on. So I can sort of see where they're coming from. I guess my optimism is that there has been that downtrend in the monthly trim mean rate of increase on a month-to-month basis, and this is what we were talking about last week. And this rate hike will have a dampening impact on confidence, because don't forget, it's not just one rate hike. I think people will be assuming more out there, and that may take the edge off demand, hence ultimately avoiding the need for another rate hike. But you'd have to say it's a close call, and I don't have a lot of confidence at this point in time. The risks are certainly skewed on the upside for interest rates, which to me is a disappointing outcome, because that we've got inflation as a problem and growth is just 2%. We used to be able to grow at around 3% before inflation became a problem, or more than 3%. Now we've just got this very modest, brief recovery, if you like, after that per capita recession, and already we're worried about inflation. That is suggesting that the inflation growth trade-off has deteriorated, and that is disappointing that that's happened. And obviously you've got to look around for what's explaining this. And part of it, I think, is that government spending is a lot higher as a share of the economy than it used to be. So it's not the rate of growth of government spending now, it's just the level is too high. And then, of course, productivity on the supply side hasn't been enough, and that's led to this situation where aggregate demand, which includes public and private, in the words of Michelle Bullock, is up against its limits, and supply is not strong enough. So that also obviously needs addressing by the federal government. You can't blame the RBA for that. That's not their thing. They'll analyse it just like economists have, but you've got to have policymakers pulling levers to get productivity up and pulling down public demand to make way for private demand.
Yeah, it's interesting, isn't it, Shane? Because we see in the States productivity has that AI tailwind. That's not happening here.
Yeah, that's right. They have an AI tailwind. They also have, I guess, a far more flexible labour market than we do. That's, I guess, a trade-off to some degree that we've accepted. High minimum wages and all those sorts of things, more protections for workers compared to the US. And I'm not advocating quite going down the path of the US, but I think there are some issues there. Our labour market has become too inflexible at the margin. We've seen a winding back of the deregulation on that front that we saw through the 80s and 90s, or the 90s in particular, and that I think is a bit of a negative. The re-regulation has gone a bit too far, but it's hard to see that getting reversed. And of course, Australian companies will benefit from AI, and that'll provide a productivity boost, but that might take a while to come through. Whereas in America, you've got this boost coming through from just having the AI companies. and being able to churn all this stuff out. So yeah, America does have a lead on this front, and we have to do things. We have to work a little bit harder to try and catch up on that front.
Well, all talking about productivity, on that note, let's knock off for the weekend. Shane.
Probably a good idea.
Yeah, enjoy it. Thanks for joining us on AMP.
Thanks, Andrew. Take care.
All right. Let's now check in on our stock of the day. Now, this was REA Group. It did report today, and somewhat negative there, certainly perception as far as the market. So what did our experts think? Well, Zach Rios from Banyan Tree Investment and Junbei Liu from Tencat gave us their assessment.
Interesting is that the result itself, with the outlook, the downgrading the listing somewhat, that's pretty much known for most of the people because we've seen the listing is a little bit softer. But what's really good is that though they are heading into a period where they're cycling really easy comps, and then heading into 2027, June, the December half in 2026, it should start seeing really soft comps. So that means the growth is actually going to pick up for this company in terms of volume. And on top of that, the company actually said the yield is actually going to be, they upgraded the yield expectations, so the price, the premium product is selling better.
About the yield, that just tells you the very sticky and important value proposition that this plays within the real estate market. Look, longer term, I think you need to be a bit mindful of what AI and the tools of AI may do to them, and this has to be married up with what REA themselves are doing. But if AI is all about data, then these guys have one of the best data sets out there for their industry. And they've got a very strong market position.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring, or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
All right, well, let's check in on the winners and losers in today's market. Oh, goodness, trying to find some winners. You know what? That chart there sums it all up. There are 5 in the green today. So led by Brambles there, which is up a healthy 3.5%. But the rest is in red. So let's go to the worst performing then. Web Travel Group, it is facing that audit for a subsidiary in Spain. It has been slammed as a result. Also, those uranium miners under further pressure today. Look, wherever you look, essentially, it is negative. Let's take a look at small caps. A few more to choose from there in terms of those in the green. Certainly IODM there. Tanami Gold, interestingly enough. Brisbane Broncos on that list, as well as Baby Bunting. Whereas a lot of the gold miners are actually in the negative, as you can see, including Austral, Boab, Andean Silver, with the silver price having taken a big tumble again. So, to what's out overnight, we do get US consumer confidence. Also, further US earnings there, Sensei, Philip Morris and Under Armour among those reporting. Now, in the week ahead, earnings season locally really gets cracking with some of the big names there, including CBA, CSL, James Hardie, Northern Star, Pro Medicus. And overseas, US retail sales, we get that on Wednesday, and delayed US non-farm payrolls report also towards the end of the week. All right, so let's recap. Well, that tells the story, if you can see the chart, off around 2.1%, red right across the screen. As I mentioned, just 5 stocks in the green at the moment, and takes us back to where we were a year ago on the ASX 200. That is the COB. Thanks for watching and listening.